Hey IFA subscribers, it's Luca, and I'm here today with a little reflection on this whole year and what the TV and the pundits and the floating heads have been saying, and maybe what you're thinking about your own investment portfolio. So as I'm filming this, the S&P 500 index is up roughly about 20% year to date. Most likely your portfolio isn't. And this is a common frustration among many investors in the market, this year in particular. The S&P 500 performance is a little bit deceiving. The majority of the gain in the market this year has come from 7 stocks, with the largest concentration in the index in terms of market capitalization, or market cap, as you've heard. You've heard the term Magnificent Seven. So the surge in those 7 stocks has skewed the performance of the broad market index. The performance of the bottom 493 stocks remains decidedly different. The market cap of those top 7 stocks is so large that it skews the performance of the index overall. You can see this by comparing the performance of the S&P 500 broad index and the equal weighted S&P 500 indices. This market divergence may not change in 2024 if pundits and the talking heads are correct in their estimates. They're actually expecting the Magnificent Seven to continue to grow faster than the rest of the index, 11% compared to just 3%. They're also expecting this to continue into 2025. You know, that crystal ball that goes 2 years into the future that everybody has. So why does anybody care? Well, why do you care? Well, when the end of this year comes and you look at your performance relative to the S&P 500, you're likely going to be disappointed. However, that's exactly what Wall Street wants you to do. It wants you to compare. Comparison is the root cause of more unhappiness than anything else. I often say that it's known as the thief of joy, if you will. It may be inevitable that human beings, as social animals, have an urge to compare themselves with one another. Maybe it's because we're all forever insecure in some cosmic sense. Let me give you an example. So assume your boss gave you $1,000 this year for a Christmas bonus. You'd be thrilled until you learned everybody else in the office got $2,000. Now you're upset because you got less than everybody else on a relative basis. However, are you deprived on an absolute basis of actually getting $1,000? Comparison created unhappiness and insecurity are inescapable. We're all going to do it. Social media is full of images of people showing off the best of their lives, giving you something to compare to. And it's no wonder that most social media users are terminally unhappy. The flaw of human nature is that whatever we have is enough until we see someone else who has more. It's the old keeping up with the Joneses analogy. Comparison in financial markets can lead to awful decisions and often do. For example, investors have trouble being patient and letting whatever process or strategy they have actually work for them over time. Instant gratification. You'd be pleased if you made 6% on your investments, but only needed 3%. However, you feel disappointed when you find out everybody else made 8%. Well, why is that? Does it actually make any difference? And here's the ugly truth. Comparison-related sorrow is for Wall Street's benefit. Shocker. Or maybe it's not. The financial services industry is based on upsetting people so that they will move their money around in a frenzy. Money in motion creates fees and it creates commissions. The creation of more and more benchmarks, products, style boxes, widgets is nothing more than the creation of more things to compare with. The end result is investors remain in a perpetual state of frustration and return chasing. We're just always trying to get one step ahead. The lesson we want to drive home here is that the danger of following Wall Street's advice of beating some random index from one year to the next. What most investors are taught to do is to measure portfolio performance over a 12-month period. That's it. That's their benchmark. However, it's the absolute worst thing that you can do. It's the same thing as going to the gym or being on a diet and weighing yourself every single day to whether you lost or gained weight. If you could see the whole future in a crystal ball, then making an investment decision would be easy. We don't have that luxury, which I know you know that. Instead, Wall Street suggests that if your strategy lags in 1 year, you should just move your money elsewhere, change up your strategy. This forces you to chase performance, creating fees and commissions for Wall Street's benefit. We chase performance because we all suffer from that 7th deadly sin, greed, which is a derivative of fear of missing out. Most of us want all the rewards without regards for consequences. Instead, we should learn to actually love what is enough, enough being a relative term. In a year like 2023, this year, where primarily 7 companies drove the S&P 500, many individuals, including some of you watching this right now, thinking that you missed out, will want to change your strategy for next year. Such will likely and would be a mistake, and you will likely be disappointed as well. You can pick any asset class that's been on top, and you'll see that they're rarely a top performer for long. Good example is last year in 2022 was that cash won because the S&P 500 index was down 18% to end the year. If you had chased last year's best performing asset class, cash, you would have woefully underperformed the S&P 500 this year in 2023. While the talking heads see the S&P 500 having another winning year, they're often wrong by a large degree. Given still elevated interest rates, tighter lending standards, the slowing wage growth, there's more than a substantial risk of slower economic growth next year. Now, that would lower inflation. It would also reduce earnings growth, suggesting 2024 could be a lower return year for the S&P 500 than it is this year. So when you sit down at the end of this year, or any year, to analyze your performance, don't just look at 2023 as your benchmark. Investing aims to achieve a stable rate of return over a long period of time so you reach your financial goals. Therefore, look at the average rate of return that you've achieved over the last 5 years and compare that to your goal. This will give you a better sense of how you're doing and reduce the potential for emotional mistakes. If you want to be a better investor, do what most people don't. Have a plan. Look for a consistent and stable return over time, not the highest return. Invest for a reasonable annual return to help you reach your financial goals, now and over time. Don't compare yourself to some anomalous index. Your life is a better index than the S&P 500. I promise you that. And then at the end of the day, just manage your money. Because after all, it is your money. It's not as complicated as you think. You don't have to go at it alone. We at IFA are here to help. We have the team of people and the resources available to walk you through whatever you need now and throughout your entire financial life. So don't compare towards the end of this year. I'm wishing everybody a very Merry Christmas to you and your families. We'll see you. 2024 is going to be here before you know it, and looking forward to seeing you then. Take care, everybody.